Welcome to Business Training's Certified Investment Banking Associate Program, video module number 3, the Valuation Overview. It's a quote here from the textbook that was part of the course saying, "Valuation is at the core of investment banking. Any banker worth his salt must possess the ability to properly value a business in a structured and defensible manner." And those last few words are very important. Anyone could value a business, possibly even picking a value out of the air. The importance here is structured and defensible. Structured meaning it's based on industry accepted methods, and defensible meaning that every number in it, every assumption can be justified and even changed. You know, if someone says your company's worth 8 times cash flow, a management team may say no, we're worth 9 times, and you can go back and forth on the reasons why. But properly laying out a valuation is key. Valuation happens to come up in nearly all investment banking transactions. In a merger and acquisition deal, it may be the case that the board of directors wants to sell a business, but they're not quite sure what value level they should accept. In an equity offering, a private equity firm might consider selling its ownership stake in the market, but it needs to know the valuation it's going to attain because it has certain investor returns to consider. In a debt offering, a company might want to know at what value should its convertible debt be exchanged for equity. And lastly, in a restructuring transactions, if bondholders agree to convert their debt into equity, they're going to want to know a valuation of the company so they know what portion of the company they'll own by converting their debt. There's 3 main types or concepts of valuation that we should consider. A market value for a publicly traded company is quite easy to determine. You look up a stock price, number of shares outstanding, a few other statistics. But an argument can be made that it's not a definitive valuation. The market can be pessimistic about a certain industry, about a company. It may have overreacted to news. So market value certainly isn't the be-all and end-all statistic. An intrinsic value is one that's based on the present value of future cash flows. Problem with this one is that it depends very heavily upon assumptions used in the valuation process. Growth margins for sales, growth margins for profitability, discount rate used to bring the future cash back to the present. All those things can greatly affect an intrinsic value. And the last one that's just worth mentioning, not used too often in investment banking, is book value. Simply the difference between assets and liabilities on a cash flow statement. Doesn't give credit to future performance. It's really a theoretical liquidation value. If a company just stopped operating instantly, sold all of its assets, paid off all of its debts, it would be left with a certain, it would be left with a bit of value, the book value, but not really something that's used day-to-day in investment banking. Big concept that we should get our hands around is the total enterprise value, basically a measure of the complete value of a business, often abbreviated as TEV, sometimes EV, enterprise value. Enterprise value is composed of equity value plus debt less cash balance. And the reason that is for example, if you're going to buy a company, you may have to buy all the shares that are publicly outstanding, so you have to pay for all the equity. You have to assume the debt of the business, but you also would then have the rights to the cash that's on the balance sheet. So that's how we get that formula, TEV equals equity value plus debt less cash. An example, assume a company has 25 million shares outstanding. It's trading at $10 a share. So it has an equity value of 250 million. It has debt of 75 and cash of 5. So just showing a formula here for the students that the total enterprise value in that case would be $320 million. Just one more item to note to make things a little more complicated on that simple equation is that it's important to use fully diluted shares outstanding for a company. Statistics are often available in financial statements. Sometimes the calculation is done for us. Sometimes we need to look into the proxy statement to get real detailed information on securities out there that can be converted into equities, such as options, warrants, convertible debt. As an example here, if the company above also has 1 million stock options outstanding, and those options have an average strike price of $4, if we assume all of those options are exercised, that would add 1 million shares, but the company will take in $4 million from the option exercise. It can use that $4 million to retire 400,000 shares, giving a net addition of just 600,000 shares. The final concept to note on this page is that financial maneuvers do not affect total enterprise value. As an example, a 2-for-1 stock split simply doubles the number of shares outstanding, but it halves the share price, leading to the same equity value. Similarly, raising $100 million of debt adds $100 million of debt to the balance sheet, but also adds $100 million of cash, which cancel each other out. There are 3 common valuation techniques used by investment bankers: the comparable companies analysis, the precedent transactions analysis, and the discounted cash flow analysis. I'll give a bit of an overview of each here, and each one will have its own module later in the course. Comparable companies analysis, also known as comps, uses publicly traded companies as a basis for market-based valuation. Bankers have to use judgment when selecting the universe of comparables. It's not just companies in the same product industry. It can be companies with similar sizes, similar growth rates, similar sales channels. And the valuation at the end of the day takes place by applying trading multiples to the target company. For example, if the comp universe trades at 8 times EBITDA, you might be able to tell your client that based on the comps analysis, his or her company could be worth 8 times EBITDA. Precedent transaction analysis, sometimes called M&A comps, uses historical acquisitions as a basis for market-based valuation. The trick here is finding financial data about the deals. Some deals involve private companies, some involve companies that are too small for the disclosure to be required by their public acquirers, and sometimes you just have to use a lot of thinking or talking to senior bankers to find out about what deals should be used in this analysis. Like the comps, valuation takes place by applying a multiple. These acquisition multiples, though, often exceed those of the comparable companies because they involve a control premium, basically a price premium paid to control a business rather than just buy into it on the public markets. Discounted cash flow analysis, also called DCF, is an intrinsic value based on the notion that a business is worth the present value of the future cash flow stream it generates. Care has to be given to forecasting and to choosing a discount rate. These can have great impacts on the results of a DCF analysis. Sensitivities are often shown where a banker might show what would happen if a company exited at 8 times, 9 times, 10 times. Discount rate may have been 10, 11, 12, 13, rather than just picking a point value. The 3 methods are typically combined, presented to clients. Reasoning has to be used if they provide too wide of a range. If M&A comps are way high compared to the other 2, you might learn that they were based on a time when borrowing was easier, people were paying more for businesses, so that would be explained in the valuation. Similarly, if a DCF is way out of whack, you might realize that that your growth rates in the forecast just really can't be justified. Bankers also need to account for outliers, maybe bump some companies out of the comp universe because they're just trading in a value that's not in line with the peers. Likewise, extraordinary items on financial statements should also be excluded in the analysis. If a company is had an earnings boost simply because it sold a division, well, that's a one-time event. It's an extraordinary item that should be backed out of the earnings and the multiple recalculated. There are a few other valuation techniques that are occasionally used by investment bankers. The leverage buyout analysis, or LBO, based on the notion that a company is worth what a buyer will pay for it, in this case a financial buyer. It involves some sophisticated financial modeling to calculate the amount that a financial buyer can afford to pay for a business. The driving factor here is that financial buyers usually need to get a certain return on their money to even do a deal. That may be something like 30%. So if you have that end goal, you could back into a purchase price based on a series of forecasts. LBO analysis is highly dependent on capital market conditions, especially debt market conditions. Buyers can pay more when they can borrow more. Next analysis is called accretion dilution analysis, and this is based on the notion that publicly traded strategic buyers will not want an acquisition to reduce, also known as dilute, their earnings per share. They're very focused on earnings per share because that's often how stock markets rise and fall. Calculations are performed by bankers to estimate post-deal earnings per share based on a number of factors, including consideration, whether it's cash or stock, new borrowing. By borrowing, there's interest expense. Interest expense reduces earnings per share. If a deal is at A stock deal, a company will have to issue new shares. Well, new shares would tend to dilute earnings because you're dividing your income over a larger base. The accretion dilution analysis is dependent on assumed synergies as well that can be gained when businesses are combined. For example, if two very close competitors combine, they may know that they can reduce a whole bunch of back office or even sales force, and that would work to counter any dilutive effect. The final analysis that we'll talk about is the contribution analysis. When two companies are merging, investment bankers may examine what percent of the combined company is attributable to each. For example, one may contribute 60% of the revenue, 60% of the EBITDA, 60% of the income, while you might tell the clients, hey, in your merged entity, the owners of that business should own about 60% of the combined business. That's all for this module. We'll see you next time.